Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on November 1st. My name's Ian,
Well,
and
wait. Today's Halloween. Happy Halloween.
happy
We're,
Halloween.
we're recording on Halloween. You got any fun plans? What are you going to dress up at?
I am dressing up as a driver because I'm going down to South Carolina.
That'll be
So
fun.
I'll be in the car for most of the afternoon. Won't get to do much trick-or-treating. What about you?
No, I'm going to go sit in the apartment. Nobody trick or treats. Gabby, my girlfriend, was sitting there saying, we need to put out like a basket of candy or whatever for the kids. And I was like, there's nobody that's going to go out in the apartment. I feel like that would be kind of awkward. Like you go knock trick or treat, then you just like turn to your right, one little deal, trick or treat.
I mean, it
So
would be efficient. That's for
yes, it
sure.
would be
We're about
candy per
efficiency.
hour.
Yeah, that
So
that that wouldn't be
get
wouldn't
those
be bad.
numbers up.
It's a bummer. We Halloween is my fiance's not probably favorite holiday.
Really?
Yeah, we don't really do anything for it. We just like Halloween. I think
Get
she
the
just
cookies and
she
the
just
candy.
likes the movies and stuff.
Yeah,
Yeah.
yeah, yeah. Hocus Pocus.
Yep.
Yep.
Yeah.
You got the whole gauntlet.
Yeah, got
I've been through it too.
the whole gauntlet. Yeah. But
Yeah.
coming in here for movement, a lot of stuff going on this week. Very
Yeah,
spooky week, I
it
guess
is.
you could say. There's a lot of action going on across the market, a lot of earnings, a lot of potential news headlines. Got a pretty important election coming up
I know.
on Tuesday.
Tuesday. So fast
And
it came up.
yeah, and you have all this stuff kind of coming in one week, and then 2 days after the election, we get a Fed decision. So
Right.
there's a lot of potential market movement going on. When we're looking at presidential elections, I mean, we hear maybe we'll start there. We'll get into some other perspectives on to market timing, and then look at some of the earnings. But when we're looking at the presidential election and how that affects markets, we've talked about this a lot.
Yeah.
It's really nice to talk about, and people get concerned, right? It's a good talking point for people. It's like, oh, I'm going to be up trading futures while the election results are
Betting
coming
on
in,
it,
right?
right? I mean, like
Exactly, exactly.
yeah,
Yeah, now that's legalized. But historically, we see, and maybe some of that other stuff will affect, like maybe betting will affect, who knows? But historically, we don't really see elections affect markets that much, at least certainly not negatively.
right. Yeah, I mean, you and I have talked about it many times. It's not about, who it is, right? I know that there's definitely, you could go and Google, right, like what's going to happen if Trump gets elected, what's going to happen if Kamala gets elected, and you could probably find like this 10 different articles that say the market's probably going to go to zero,
Yeah.
right? Like the country's going to go up in
Or
flames.
yeah,
But it hasn't necessarily, at least historically, really mattered if it's a Republican or a Democrat. And even in this case, I would go as far as saying both candidates with some tie to the White House or have some tie to the White House in their first year, they saw outsized or above average gains, right? So,
mhm.
Trump in was it 2016,
17.
2017, and then Kamala with Joe Biden in 2021.
Yeah.
So you get that outsized gains in either way. So maybe history repeats itself.
Yeah, and we talked about this before from the perspective of the markets generally tend to do pretty well in the fourth quarter of election
Right.
years, and they do pretty well actually in the second half of election years. And we've gotten at least that part has certainly started to play off pretty well in line, at least maybe a little bit better than what we've seen historically. When we're looking at it from a straight performance standpoint, I mean, we see the average performance in the third quarter of an election year sits at 5.22%. We saw 5.53%
Pretty
this
close.
third quarter. I mean, it's hard to get, I mean, we're never going to hit the average, but we got pretty
Right.
close to hitting the average. Just a few ticks away from that over in the third quarter. We're on a pretty kind of decent run so far through as we head into the fourth quarter of the year. But I mean, 2.31% in the fourth quarter of an election year is the average. That would be fine.
Right. I mean, we'll take it.
We don't need another 5% quarter.
No.
It would be good. We'll
Yeah.
take that too. But you don't necessarily need it. I think the important thing to note is that it's not necessarily the magnitude, but the consistency. You see the fourth quarter of an election year is positive 75% of the time, going back to 1928.
That's actually the most. I don't know if we're going to throw the chart up or not, but if you compare that to the other quarters, just for reference, 75% is the highest hit rate
Right.
of those. So you get 75% of the time, 3 out of 4 times. So that fourth quarter of an election year is positive. All of the other quarters also notably above 50%, but not as significant, right? So 60%, 64%. You get the fourth quarter jump. And a lot of that, I think, again, is due to that comment of uncertainty. By the fourth quarter, the elections happened. you kind of are able to digest what's going
Hopefully we
on.
know who's president.
Hopefully, right? The elections happen, the market is able to digest what's happened, and then can kind of go into the fourth quarter, open the new year on the right foot, understanding who's the candidate is and what their policies are going to be.
Yeah,
So,
yeah. I mean, we talked about that. We see that play off we see similar results when you're looking at the large cap space, and similar to when we're looking at kind of the small cap space, although we haven't necessarily seen small caps pick up the pace as much this year as they typically do in election years, right?
right. Yeah. So, I mean, we can just do the exact same strategy or strategy study with different areas of the market. So, S&P 500, kind of an average year for the S&P 500. What's an average election year for presidential term look like for the Russell 2000, for gold, for copper, for, you name it, we can throw that together. The Russell 2000 also quite notably positive over the course of the fourth year. And then more specifically, I don't have the exact performance metric on there, but on average, positive, stoutly positive during the fourth quarter of the election of an election year as well, for small caps. So again, haven't seen that participation pick up there, but is an area that we would love to see some tailwinds, and move forward there.
Yeah, small caps have been kind of lagging the broader market for quite a while at this point, but we've seen a more consistent improvement from small caps recently.
Right.
The drops haven't been as big. The improvement has been kind of ticking up a little bit more toward fresh highs, right? And so it'd be good to see that kind of really pick up the pace in the final couple months of the year.
Yeah, and all this stuff, I mean, maybe this is a nice segue into seasonality and other things. All of these items, we're not going to go and trade specifically on the fourth quarter of an election year.
You might not.
Excuse me. Yeah, well, maybe.
No, you're right.
But, we're not going to go and say, okay, well, historically, the fourth quarter is positive 80% of the time. So that and that alone is the reason.
That's not moving our portfolio.
Exactly, right? We're looking to build, properly named, the weight of the evidence.
Yeah.
For one direction or the next. And so talking about things like the fourth quarter of an election year, things like seasonality, which we can open up that conversation now, talking about a seasonally strong part of the year. Right?
Yeah, absolutely. I mean, so while we don't necessarily trade our portfolios based on elections, we do have some portfolios that are going to change, or at least have the potential to change, based upon seasonal periods. And so it's a classic market adage, right? Sell in May, go away, come back in November. So we do have some portfolios that are going to switch, overweighting maybe areas of momentum during the historically seasonally strong period from November through April, and then underweighting momentum, overweighting low volatility during the historically seasonally weak period, which would have been from May through the end of October, right?
Why do you think it's weak?
Why?
Yeah.
I think it was weak back in the day because we didn't have the markets on our phones all the time. And so when people left for the summer, then there wasn't as much action going on in the market. And so it would have been a kind of a more weak environment. There wasn't as much action going on, so markets didn't go up as much. I guess it's kind of,
I suppose,
probably why.
Yeah, everyone's on the beach, they're not doing anything.
But now you can manage your portfolio from the beach while on your phone, right? And so it's and it doesn't really matter as much anymore. And we definitely didn't see that historical adage play out this year. We were looking, the S&P since the end of April is up over 15%.
Right.
And so we didn't see that historically weak period lead to weakness in the market. But I think an important thing to keep in mind is that it's not necessarily following that, or like every weak period is not going to be weak. Every strong period is not necessarily going to be strong. It's more looking at potential shifts in market movement. I think so we do have other portfolios. Our fund score models, our FSM models, are going to be evaluated based on seasonal quarters. And Steve always brings up an important point with that it's not necessarily saying we're going to move into low volatility stuff during the weak period and move back into momentum for those. It's just looking at times when we've seen shifts in sentiment historically. And so trying to take advantage of those shifts moving forward and get you kind of off calendar with those as well. But yeah.
For those of you who are, just to jump in real quick, for those of you who are unfamiliar, Steve is kind of the mastermind behind the fund score methodology and then kind of that whole deal. We've had him on a couple times, and possibly we've got some evaluations coming up. He might be joining us.
Be great too. But he's got a lot of perspective on historical movement. And we get that question a lot, like, why do you look at off calendar quarters? Why do you look at seasonal quarters? Does it just sound nice? Well, yeah, it does.
It's different.
It's different, right? And it's a different evaluation point. And we do see changes in sentiment do tend to occur maybe more so at those times than at other times in the year. That's a little bit of an aside. But when we're looking at seasonality and the market movement, now we do the beginning of November brings about the historically seasonally strong period. And we were looking at some stats. Again, it's not necessarily if you only held it during the strong period, you're not going to beat the market.
Right.
But you get pretty close.
Right. Yeah.
Right? I mean, I think that's an important thing.
Oh yeah, I mean, you take a look at just owning the S&P 500 while you are in that seasonally strong period of the year compared to just a buy and hold strategy or oh wait, I guess this is the Dow.
I think, yeah.
There you go. So owning the Dow.
We'll throw this chart up there.
Yes, owning the Dow during just that seasonally strong period of the year versus just owning it during the seasonally weak part of the year versus just buying and holding throughout the entire time. And while again, as Ian mentioned, you don't keep up with the market, you don't beat the market per se, you're pretty dang close when it comes to just buying that during that seasonally strong part of the year. So again, we're not just going and making our investment decision like, hey, we don't like stocks right now, we don't like domestic equities right now because we're in a seasonally weak period.
Right now.
Right, exactly. But it's about saying, hey, this is just another domino that falls in the camp of, hey, this is seasonally strong. Now, here's the thing. We have seen the market go up for 2 years, right? Do you think, well, what do you think? Or do you think that markets are going to, do you think we're due for a pull? And this is just a bigger conversation.
I don't know. We'll let the charts tell us. Right?
Okay.
But no, I think it's helpful to look at that. And I think you could see some other areas of the market, like we're talking about small caps. Maybe it's not the areas that have been leading are going to continue to lead. But right now it looks like that hasn't necessarily been changing. Always something we're looking out for. But for those that aren't looking on YouTube, where we'll have the chart up, when you're looking at the seasonal periods, if you just bought and hold the Dow going back to 1950, you'd be at a 7.32% annualized return. Just buy and hold. If you only held it during the strong periods, you'd be at a 6.94%. Pretty close. I mean, that's 40 bips a year annualized is pretty close, right? Weak periods at 0.35. And so we haven't seen that play out as consistently recently, I think is something that a lot of people kind of point toward. We've gotten two consecutive, but we have got prior to this year, two consecutive negative periods. 2022 and 2023 were both negative during the seasonally weak period and strong during the seasonally strong period. We've just seen a lot of strength over the past year, which is a good thing. I don't think anyone's complaining about that.
No.
But we're just looking at that consistency and historical averages over time, right?
Yeah, and further in that point, there's some bullet points that we've got on that. So you're talking about the hit rate with with presidential elections. Looks like nearly 80% of seasonally strong periods going back to 1950, like you said, for the Dow have been positive. Now, seasonally weak, 61. So a lesser percent, still more than half the time, right? Like when you look at the market in general, you're positive more than you're negative, right? But just talking about, less of a hit rate and also the magnitude of those positive hit rates is less than what you would be seeing during seasonally strong parts of the year. So again, that's where that kind of origin of the study goes through.
Yeah, no, I think that makes sense. So when we're getting into strength and weakness, right? It's hard to not talk about earnings.
Yeah, that was the other thing that happened this week.
A few, just a few big companies, right? I think it was 43% of the S&P was reporting earnings this calendar week.
Right.
By market cap, so not necessarily by name. I think they're 161 or 150, something around there. Check out the research piece that we put in there on Monday. Over 40% of the S&P by market cap was reporting earnings this week. 23% of those were just from 5 stocks, right? I mean, the 5 of the Magnificent Seven. Tesla reported earlier already, reported pretty well. NVIDIA is reporting later. We'll see what happens there.
Next year, pretty much. They feel like they're always like out.
They're always at the end, right? They got to be, someone's got to be different.
The special, yeah.
But when we're looking at the 5 names that did, Google, Microsoft, Meta have already reported. And by the time this podcast comes out, Apple and Amazon would have reported as well. We're recording this Thursday morning, actually Thursday morning pre-market open, but Apple and Amazon reporting after close on Thursday. But for those 3 stocks that have already reported that at the time we're recording here, kind of a mixed bag, right? In looking at those, Google showed some strength after their earnings release. Meta and Microsoft, at least at the time of this recording, prior to market open on Thursday, are showing a little bit of weakness, but not necessarily technical deterioration,
Right. Yeah. I mean,
Right.
all these stocks, sans Google, which we can talk about in more detail, because I think that that technical picture is intriguing. These stocks, Meta, Microsoft, they are, five for fivers, pulling back a little bit to relevant levels of support. I would say, in my opinion, they still look pretty strong. Hasn't been a technical breakdown. Now, for those of you who are listening that might have a little bit of a fundamental tilts to your analysis, certainly go dive into the balance sheet, the cash flows. I won't be doing that, but definitely go look at them to see if they don't pass your fundamental screens anymore. But from a technical perspective, they still look pretty strong.
I mean, you have these stocks up at or near all-time highs. Seeing a little bit of consolidation, I don't think has to be a bad thing too, right? I almost would be more concerned if they blew it out and we're up 10%. Because
Right.
then you're getting into
And like,
overbought.
what are we doing?
Right.
What there seems like there's only down to go. If they were up 10%, they kind of uses up all their runway, right? Versus,
We
well, maybe.
could keep running,
Yeah,
right? I
I
mean,
guess they
we
could.
kept saying how many times we say that in the video. It can't go any higher, and it kept on going higher.
Yeah, I suppose.
But one stock that didn't have its so Meta, Microsoft, stronger technical pictures going into earnings, looking like a little bit of consolidation there. We'll see what kind of shakes out during the actual trading on Thursday. But still generally favorable. Meta, more favorable technical picture than Microsoft right now.
Right.
And showing Microsoft certainly showing more weakness, at least pre-market, after its earnings release. But Google, Alphabet, sorry, Google, A shares there, was not showing strength going into earnings. It showed a lot more weakness than I mean, out of the Mag 7, Tesla was showing a lot of weakness, much more weakness than Google. But Google was showing, I mean, it topped out at 190 in July and had a pretty kind of clearly defined negative trend over the past couple months.
Right. Yeah. I mean, I'll be honest. And we can throw this specifically this chart up on the screen. Time will tell, if that trend break was significant. To me, it was, right. And so, you get a trend break back into a positive trend that pushes it back to a technically acceptable 3 for 5 by the book. That is going to be positive, acceptable, right? Like, I personally am not quite sold. Just looking at the chart, that trend line over the course of the last year has been really strong, lifting Google higher. I don't like a break of that, even though by the book a 3 is still acceptable. I'm kind of still a little out.
Yeah, well, it's only a 3 for 5, right? I mean, that would kind of classify it as more of a hold from our recommendations. It was a 2, now it's a 3. Still technically sound, technically favorable.
Yeah.
But it's only a 3, not an area like, oh my God, you have to jump into it now, right? It's good at showing improvement. You need more consistent improvement, and that consistency will lead it to raise an attribute score if it gets there. It's in a column of those against the market and its peers.
Right.
So we're going to need more consistent improvement against both of those areas if it's going to continue to improve technically. It's a good start, though.
Right. And when we say comma those against market and peers, we're just saying, hey, we're seeing some near-term relative weakness against those groups, just as an inside scoop for the uninitiated. So some near-term weakness, but technically speaking, if you were just going to cover up the chart, not look at anything else, I think it just depends, what is more significant, that longer term trend break towards the downside, or a bit of a pullback or rally back up and break back into a positive trend. Are we just going to continue that trend that we were in before? Or is it something where we're just going to kind of consolidate for a little bit, see less consistent trends for Google and kind of go from there? I'm still kind of jury is out in my mind. If I have holdings here, I'm just sitting on my hands. I'm not going to go and initiate anything new personally. But that's just my view on the chart. You might have a completely different one.
No, I think that makes sense, but those listening might have a different view too. But you got to take the attribute for kind of what it is. That's generally what I kind of tend to look toward. When we're looking at other strong attribute areas, though, I mean, the Apple and Amazon, both 5 for 5ers heading into their earnings release this afternoon. Both also have kind of, I mean, different but similar pictures at prior resistance, not on buy signals, but at prior resistance levels. I think it'll be interesting to see how those shake out as we move forward. Again, either of those areas, Amazon has shown a little bit more kind of consistency recently. Apple, again, at those kind of matching all-time highs from July, would mark a new all-time high with potential movement to 240. You got initial support coming in at that 216, further support down at the 196 point for those following along. When you're looking at Amazon, you got more steady support offered in there, but a little bit more room to run before you get to that all-time high as well. So it's a little more consolidation from that stock, I think.
Yeah, I mean, there's going to be obviously a lot to watch. Markets are going to probably be moving when you got the election stuff, like we talked about. Then you have earnings from these big names. Of course, some of them end up being non-events, but if you get big moves in either way, markets start to sway. And so, remember that when we're going through this stuff, we'll be just, allowing markets and charts to tell us what they tell us, right? And so, don't necessarily chase the headlines on these types of
Yep.
things as you're going through, no matter who wins the election, whenever we figure out who that is. Don't necessarily go and chase headlines on this type of stuff because there will undoubtedly be there. When you're going through, so remember just to treat everything in an emotionless as emotionless as you possibly can when you're looking at money management, investment management.
That's well said. Well said. And then we'll hop back on next week and talk about the Fed rate cut. Or
Yeah,
maybe,
just going through the gauntlet.
maybe rate cut. We'll see. Cool. Well, I think that kind of wraps us up for this week. So, Miles, thanks for being here with me
It was a
and let me
pleasure,
sit
man.
across the table
Safe
from you.
travels and happy Halloween.
Appreciate it. And happy Halloween to all those listeners as well. Thanks for tuning in this week, and we'll be back to touch base next week.
See ya.